We're going to talk about hard money loans. I put this together last night with my kids constantly needing my attention, so pardon me. It's a free event. I want to put that out there. Okay. So just to give you some background, in case you don't already know, my name is Nick Beveridge. I've got about 11 years of experience in the real estate world as a broker and investor. Currently right now, it's somewhere over 20. I've got 20 active real estate projects. So these are like houses that are being built or renovated, or they're in the pipeline of either as BRRRR projects or Airbnbs or spec builds that we're going to sell or flip homes. So thankfully I got a great crew, a lot of people helping us make that happen. Got over a dozen rental properties. I feel confident that if I were just to fire everybody and just go home, I can live off my rentals and be just fine. I'm not going to do that, Brandon, Nick, Jeff. But I feel like I finally got to a point where it actually worked. You know, the first house I bought, it cash flowed like $200 a month. And I was doing the math. I'm like, it's going to take a lot of these fucking houses to retire someday. But the math worked. It like over time, the rents went up. The mortgage stayed the same, and I was able to get equity out of these properties and reinvest. So I'm at a point now where I've got $6,000 of cash flow after mortgages are paid that I could probably live off of if I cut my expenses. You know what I mean? Just kidding. And I'm on a real estate team that does over 100 transactions a year. So we've got a lot of experience doing real estate transactions. Not just for ourselves. About a quarter of that is ourselves. But we have a lot of fires to put out daily, and we're in the business. We get to see a lot. I've done probably over 1,000 real estate transactions in the last decade, and it's been, or been a part of it, sorry. And I feel like I'm at a point now where I can actually talk about real estate and be a little confident about it, which I don't think I can do that with any other topic. And I've spent thousands of hours in real estate investing seminars and trainings, and every day, I kid you not, I'm listening to a podcast when I run in the morning or doing some sort of workout. So I'm just in it. I'm obsessed. I don't have any other obsessions like real estate. It's just something I do constantly, and I feel like I've got some confidence when I speak about money and finances and real estate in general. So if anybody has any questions, they want to contest what I'm saying, I'm all ears. I'm probably wrong on a little bit of this, so help me out. And it's a free event, so. First, we're going to talk, before we get into the lending aspect, I want to talk to you about money a little bit. And for a few of you out there, you may have a distorted idea of what money actually is. And I want to talk to you about what money is, learn about securities, what protects money from the actual elements out there, and try to understand inflation and how you can use it to help you to where it's not hurting you. So take a break. Take a break from what you think you know about money, if you would. Open your mind. Let me confuse you. I'm going to offend a few of you. That's what I do. I've probably already done it tonight. And I want you to think of money as water. Has anybody ever heard this theory? Raise your hands. Perfect. 4 people. 5. So I want you to really think about this. Money is just like water. And there's a lot of terminology out there to back me up when I say this. Think of currency. What is a current? Like a river current? Currency, it's moving, right? So currency is money. It's moving. Think about a river. Think what controls a river? What controls currency? Typically, what? River banks? Right? Banks control currency, right? Think of the terms out there. Cash flow, slush fund. Let's pool our money together. Someday I want to have multiple streams of income. Let's make it rain, bitches! Right? Think about it. Is this catching on with people yet? Think about, have you ever heard about a whale in a casino? Trickle-down economics. If you made a bad investment, you might want, I took a bath on that. You're just dumping money down the drain. What is a loan shark? It's somebody who typically wants to turn you red and pull you underwater, right? Or your bank account. You ever wonder why it turns red when it's not good? Has to do with blood. You ever heard my mortgage is underwater? I'm trying to stay afloat. Try to keep your head above water. It's fine. I'm drowning in debt. You ever hear about a government bailout? Think about a bail? I'm going to bail you out of this mess. What happens when you can't move your money? Does it get frozen? You know, if you've done bad things, your accounts might get frozen. Can't move your money. What happens when it dries up? It's gone. You ever heard the term liquid assets? Do you think there's a reason for any of this? So why does any of this matter? Take a guess. Anybody want to chime in?
Because like water, money is our life force. It goes hand in hand. We need water, we need money.
It's a resource.
Right.
So money, just like water, is a resource. It's not a thing that you should store. It's something you can create, something you can use, but without it being secured, it goes away quickly. Who knows that the US dollar used to be backed by gold? A lot of you, right? Gold is a hard asset, right? Hard. Think about that term, hard asset. And it's secured. Back in the day, when you got paid and your dollars were backed by gold, it's just like getting paid in bottles of water. Because that bottle was securing the water in place, right? Where it can't spill. In 1971, the rules of money changed. And this is why a lot of people are broke. They don't understand how money works. They don't understand that back in the day, get a good job, save your money, and you'll retire. Those things don't work. It's hard to save your way to wealth, right? Has anyone done that successfully? They just saved up money and they're wealthy now? Show of hands. No. Not working out. Well, it used to work because before 1971, you can save money and it didn't really spill much. After 1971, the US dollar became a fiat currency. So a fiat currency is a government-issued currency that's not backed by a commodity such as gold. It gives central banks greater control over the economy because they can print as much money as they want. It's not backed by anything. So think of water again. This is how you get paid these days. And you can put it in there. And the water goes away eventually. It goes bad, it evaporates. And look at this. Now, here's something that's going to maybe blow your mind, or you may already know this. But if you were to look at inflation and historic inflation, the government lies to you. They say, over the last 100 years, the average inflation is this. They're averaging all this, but money changed then. Inflation is much more than 4% or 3%. And they don't even calculate all the things they should be calculating when they tell you what the appreciation, or sorry, what inflation is. But inflation, realistic inflation over the last 50 years has been above 10%. It's been closer to 13. So know that the purchasing power to the dollar, picture, if you're saving money, you're basically choosing to park your money somewhere. And that's just a bank account. And this is like your stock portfolio of how that cash performs over time. It's one of the worst performing assets out there is the US dollar and holding cash. Especially after this time. Because they could just keep printing it and it's not backed by anything. And it's a supply and demand thing. Think about what we just talked about with real estate. Less supply, more demand, prices are bigger. The more supply of money we have out there, the less and less it's worth over time. So you can have the same amount of dollars, 50 years ago as today, and it can't buy you the same amount that it could back then. You guys probably already, I'm sure a lot of you know this. So inflation is a hidden tax that destroys purchasing power. Inflation destroys savings, stocks, bonds, equity, even including equity into real estate. But it also destroys the value of debt. So we've talked about this before, right? So I personally think it's a good idea if you can get a decent interest rate, 30-year fixed, on a house and have it rented out where that payment stays the same for 30 years. However, the rents may go up. They will go up over 30 years, but your payment stays the same. It's how people that invest in real estate, even if they just have a couple of houses, they become millionaires over time. Because the prices go up, the rents go up, but their mortgage stays the same. You got to think of inflation like the natural evaporation of standing water. And what is water? Resource. And money. It's money. Okay. Was that helpful? A little bit?
Yeah.
Anybody learn something new? 2 people. Sweet. Thank you. But I want you to think about it just differently. Like money is not, I personally don't think it's a good idea just to save it. Maybe right now. I don't know. Depends on what your situation's like. But you're always investing in something, and if you're not investing in anything, that's what you're investing in. Does that make sense? Okay, so let's talk about hard money. We'll talk about what it is, when and how to use it, and a couple examples, and then we'll open it up to Q&A. Okay, so a hard money loan, most people think of it as it's hard because it's expensive and they beat you up and they kick you in the balls, right? It's a hard kick in the balls. A hard money loan is a loan from a private or non-traditional lender where the asset is being purchased and used as collateral. So the loan is secured by a hard asset. And that's it. It doesn't mean a hard kick in the balls. It just means that like a house is a hard asset, and that's what's securitizing the loan. Does that make sense? That's it. So here's secured examples of secured loans and unsecured loans. A secured loan would be a mortgage or a hard money loan, an equity loan, a car loan, a business loan. So basically, if a borrower screws up, stops making payments, the lender has something that's tying that note to the obligations, and they can go after some sort of hard asset to try to recoup some of their losses. So they can go after the house, they can repo a car, they can go after that equity in the house, they can take over a business. Unsecured is more of a personal loan. A credit card, student loans, they can't take your knowledge away from you. Medical bills, they can't go in and grab that leg that they fixed. So these are unsecured loans. Make sense? So when you think of hard money, I want you to just think hard means it's a hard asset that it's secured by. That's it. And then you'll know more than 95% of the investors out there. Because most people just think it's a hard kick in the balls. And if you look at a few websites, that's what they show you. But it's different. Before I tell you a little bit more about what hard money is, we'll tell you what a hard money loan is not. A hard money loan is not a loan to help you with a down payment on a real estate investment. So if you've got a great investment and you want to pull your money with some people and you need a hard money loan for your down payment process, that's not what this is. And just to clear that up even more, it's where you're getting a loan to purchase property that can be used as the collateral. So, does that make sense? A hard money loan is not for your personal residence. This is for business purposes only. So this is a property that you're not, if you're the owner, you're not going to occupy that house. You're going to fix it up and flip it. You're going to build on it and sell it. You're going to rent it out. Anything business-wise except for personally using it. Does that make sense? And it's not to be used in any second lien positions. So don't go applying for a hard money loan thinking that you can get a loan on a property that already has a loan on it. Unless there's a lot of equity and you're doing cross collateral, but that gets a little more complicated. And I'll talk a little bit more about that later. But just know, in general, a hard money lender, they only want to do a loan if they're in the first position. Does that make sense? Okay. A hard money loan is not for people with no money. Don't think if you're completely broke, you just got a hard money loan. If you're completely broke and you have no equity or anybody to help you out, it's probably not for you. Because there's still going to be expenses out there that are going to haunt you. Now, I have put together millions of dollars in hard money loans where I didn't really have any money into the deal. It didn't mean I was broke, and so it's not impossible. But in general, that's not what they're for. They're not for people that don't have money or skin in the game, is a better way to say it. Hard money is ideal for the following. It's ideal for fix and flips. It's ideal for the BRRRR strategy. If you're buying a property that needs work and you need renovation money or something like that, and you're going to refinance it. It's ideal for new construction spec home building. It's hard to get loans otherwise. This is ideal. It's ideal if you are just working on a project for 1 year or less. If it's going to take longer than a year, may not be right for you unless the cash flow is just insane. Does that make sense? So if you're going to sell the property or refinance it within a year, it's ideal for that. If it's going to take longer, probably not. Here's what matters to lenders. Typically, it's the 5 C's. So it's your capital that you have, the character, mainly your credit score, or if you're a repeat borrower, any kind of collateral that you may have, or the collateral of the property that you're buying, any capital that you're putting towards the deal. Oh, sorry, I talked about that. Your capacity, and Conditions, sorry. The wheel does not match the line. And then conditions of the loan. Now, with a hard money lender, this is where it's at. It's all about that loan to value, baby, right? This is what they really get off on. They want to know, how much of a loan are you asking for? What's the property worth? That's what they care about the most. Does that make sense? If you're buying a property for $60,000 and it's worth $100,000 as is, that's what the hard money lender says yes. Probably if you're a criminal too. They'll be like, sure. Because if they can take it back and be okay, it's probably a good loan. It's all about that LTV.
Especially after you did some repairs to it and then messed it up and they said, well, thanks for doing half the work.
So if you're new to this, write that down. Loan to value. Probably the most important factor of any loan out there. And it's the same with conventional mortgages too. And you might be wondering, but some conventional mortgages, it's 100% or 96.5%. But no, they're really all 80%. You just have these other government entities that are willing to guarantee the other 20% or the other 17.5. Am I saying that right?
Yeah, that's what your private mortgage insurance is for.
Private mortgage insurance. So these other people that come in and charge you extra for that, you know, the risky part where you're getting a loan for what it's worth.
Nick, you just used an example of 60%, $60,000, $100,000 value. Is 60% the number that hard money lenders are kind of looking for?
It depends on the deal. 60% is kind of more of like a no-brainer. They may go higher. They may go to 80. It depends on the deal. And if you don't know how to how do you calculate loan to value? You take your loan amount that you're asking for. How much money do you want total? Divide that by what the value of the property is, as is, or what the property will be valued at if in your loan amount you also have renovation money in there too. So total loan amount that you want, what's that total value that it should be? And don't be optimistic, just be realistic, especially in a market like this. So here's what's ideal. Loan to value. 70% or less is ideal. And that's how I do my underwriting whenever I just choose to buy a deal or not. If I can't get a house or a property if my total all-in costs are going to be 70% of what the value is, then I might buy it. 80% is okay. 90% would be too risky. Now this is why. If you got a loan for $90,000 on a house that's worth $100,000 and you stop making payments, and let's say those payments were around $800 a month. What's 800 times, let's say it takes 6 months to foreclose? 4,800. So now you're at $9,400 or $94,000-ish is what you owe on a property that's only worth 100. If the lender has to take that back, they still have to pay a realtor 6%. They have to pay closing and escrow fees of 1% to 2%. And then whatever other expenses that are involved with getting the property back and the hassle and their time, and they're going to lose money. If they make a loan to you at 90% of the value, there's a good chance if they have to take that property back, they're going to lose money. And this is why 80% is typically okay with almost everybody across the board in the world. Because if they have to take the property back, they can usually recoup all their costs and maybe make a little bit on the house when they sell it afterwards. Does that make sense? So 80% is typically okay, but a hard money lender, they would prefer, most likely, depends on the deal, depends on the situation, depends on the borrower, but you're typically a little safer at 70% because hard money lenders are usually a little bit more expensive, and a real estate flip transaction or a BRRRR transaction, you're usually spending more money than you think you're going to spend on renovations. So that number may not be accurate. Does that make sense? 100% is just out of the question. Unless you're getting a government loan, the government does stupid stuff. Right? Yeah. Whatever it takes, right? Whatever it takes to get voted. All right, here's an example. I'm going to show you the very first flip I ever did. And we got this home under contract back in 2014. We called it the Snake House.
Oh, yeah.
This is when it was just myself and my brother Sean and a dream to one day retire. And now we work harder than ever. I'm just kidding. So we called it the Snake House. It was an off-market deal. It was referred to me by Yvette, who runs one of the other REIs in Spokane Valley. It was her cousin inherited the home. and inherited the home. He was out of state, and it was their grandmother's house. And I guess after she passed, some tenants moved in, and they just destroyed the house. Totally destroyed it. They're meth heads. What do you expect? They tore the place apart. Thankfully, it was mostly a cosmetic job. We called it the snake house because there was a snake room. Okay, so when I talked to the seller, and this was my negotiating skills back then. I told the seller, because it was actually more of a listing referral. Hey, this guy's got a house to sell. So I went into it knowing we could probably sell this thing for $65,000 on the MLS as a listing in its as-is shape. And that's what I told him. And he said, well, my cousin Yvette told me you're a real estate investor. I'm like, yes, I am. I'd never done anything in the past. I was an agent, always wanted to invest, didn't know how, didn't have any money. And I said, yes, I am, but you're not going to like my number. I'm like, I'd have to get it for like $43,000 for it to make sense for me. And he just immediately, he's like, how about $45,000? And the guy that I was doing, I was on his team at the time, TJ Barnhart, big successful agent in the area. He was standing next to me, overheard the conversation, and he grabbed a sticky note and he just wrote, lock it up. And that was my cue to be like, okay, this guy's smarter than me. He's very excited about overhearing my phone call. I'm like, okay. And I just told him, okay, I'll buy it. And then I, went into panic mode because I didn't have $43,000 or $45,000. I didn't have $400. But we got an inspection. The inspector, I referred her many deals, and this was at the time when inspections cost about $350. She did it for me for $100 because I referred her a lot of business, and I didn't have the $350. I still had other money I had to spend. We got a contractor bid. It came in at $40,000. We got an appraisal because we were using this other hard money broker in town. They're not so great. It was $475. Now it's like 3 times that much. The home appraised for $65,000 as is, which was pretty cool because that's what I told him I thought it would sell for. And the after repair value was pretty spot on to what I thought it might be, $115,000 at the time. So we felt like we were pretty ready to get a loan. Like we had a scope of work, we had a home inspection, we had an appraisal with the ARV, we had an organized business that we created with LegalZoom, and our hard money lender just told us to screw off. They're like, yeah, you guys don't have any money, you don't have enough cash flow reserves, so no thanks. Oh, and we can't lend in Idaho. But thanks for that $10,000 for the seminar. So it's funny, but my brother spent all his money with them to get hard money, and then they told him, no, you don't have any money because we took it all. So we can't give you loans. Another story for another time. But anyway, I called a second private lender, not necessarily a hard money lender, but I started getting names from people in the industry. He said, you're not experienced enough, sorry. Called another lender. Yeah, you don't really have any skin in the game. No, sorry, thank you. Luckily, the seller was still going through probate, and we didn't have to close right away. It bought us more time. 4 months later, I had talked to so many lenders, dozens, that just told me no. And then 4 months later, the seller called and said, hey, we're ready to close. We can close in 2 weeks. Now, it's still getting shot down by lenders. And I called my old neighbor that I knew was a real estate investor, and I had him walk through this house with me. He had 45 years of investing experience. He walked through this, and he was pretty positive. He's like, yeah, this is like $45,000. That's a great deal. And I'm like, would you partner with me? And he told me no. He's like, this house doesn't fit my criteria. Screw off. So thanks. But at least it was enlightening to hear from him. It's a good deal. But it's different times. Money wasn't as thrown in your face as much back then. A lot of people will turn you down. I eventually found a hard money lender on Craigslist. Called him, and he thought he can help me out, and we did a lot of back and forth. If we could just come up with $1,000 down, he'll give us this loan. And he'll give us, so he'll pay for the house, and he'll give us another $5,000 towards repairs. Not up front, but as we do stuff, he'll reimburse us. But he's like, he's like, come up with at least $1,000, man. He's like, yeah, I have some skin in the game. So we did that. We took like a week to detail cars. I sold a motorcycle that I had, and we came up with $1,000. The loan to value on this purchase was 65% or 67% for the as-is value and the loan amount that I was getting. If you include the what it cost to fix up and the after repair value, we were at a 43% LTV. A couple weeks later, we started work. This is back when I used to work on houses, and I did a lot of the work myself with Sean. We didn't know what we were doing, but we looked on YouTube a lot, and we got it done. It ended up costing $11,500. And thankfully, my wife had a credit card that we used the other $6,500 on, and we got the $5,000 from the lender. We were able to sell it for $120. We made $44,800 in a couple of months. It was more money at the time than I had made that whole year selling real estate, and it was one deal. And it was on hard money. The loan fees were a lot, but this was all I really cared about. That's what we made. Here's a more recent example. Now, since then, I have gotten, I think, a little over $9 million in hard money loans. So I'm done a lot of business with hard money loans, and I still get them. This was one that was just funded less than a month ago. It's over in Sagal, off Blue Heron. I purchased it from a wholesaler for $400,000. The repair budgets were pretty small, $12,000. We're gonna swap out a deck and like a water heater and do some carpet. $12 grand does not go as far as it did. I got that whole house done for less 8 years ago, and yeah, now I can do a deck. Deck and some carpet. We had some title, escrow, lender fees up to 20. So this was a combination of hard money fees, title fees, escrow fees. All of it, the upfront fees were about 20 grand. I also financed 3 months of an interest reserve, $11,125. So that way I don't have to make out-of-pocket payments. Does that make sense? Because I'm pretty sure we can get the deck done, get it sold within 3 months. And if it goes on to a 4th month, then I'll make a payment of about 1/3 of that. The total loan amount was $445. The after repair values, $550. Our loan to value is 80%. Now, I get treated a little bit differently because I do a lot of hard money loans, and I didn't have to bring any cash out of pocket. But the lenders are super secured on this deal. They have 2 of my properties with over 300 grand of money tied up on equity. So it doesn't affect my bottom line at all. But if I were to screw up on this loan, they have the option to, if they can't recover their costs on this loan and they're still out of money, they can still go after one of my other properties for the equity. So it didn't really cost me much extra. It might have cost an extra $800 in title insurance fees and stuff for them to, because they have to pull title on these other properties. And what I'm talking about is a cross-collateral, losing saliva, cross-collateralization. And sometimes it's just as good as cash because it securitizes the lender's position in the loan. No extra money out of my pocket. Takes a little bit extra from my bottom line, not much, but it frees me up to scale and do more deals. I can't do 23 deals if I have to make $3,000 a month payments. It's just a little too hard for me. But if the deals can fund themselves, if I can get a low enough loan to value and feel confident enough to get all this stuff wrapped in and still make my profits, I'm willing to do that to be able to hire more people, do more deals, make more money. Does that make sense? Oh, cross-collateralization. Yeah, there. Big surprise, we lend hard money now too. So the first guy that lent me money on that snake house, he's our underwriter. Him and this guy named Thomas Citron who moved to Florida. They work together now. They used to be like arch enemy competitors. One guy's out there getting the money. The other guy's doing the underwriting. And we opened a little brokerage of hard money lending. So if you guys, big sales pitch, if you ever need a hard money loan in the future, let us know, let Kelly know. There's multiple options out there. That's our logo. That's our guy. All right. Here's something I want you to take personally, though, if you can. If we say no, you probably shouldn't buy the deal. Does that make sense? Yeah. We're going to help you underwrite the deal that you're looking at. And if we say no to it, you probably shouldn't buy it. Go ahead, Larry.
So how many lenders do you have to go through before you find they got you say yes? You know, I admire your persistence on that. That's.
Oh, it was over 15 or so.
Yeah.
It was a lot. But at the time, I really did not have any money. All I had was a good deal. And if you're going to somebody and you're asking them for 50 grand and you have no money in the bank, it's not always going to end well. Right? But it's all about that LTV. So what I was able to convince this guy was, hey, I'm not going to go to it now, but hey, if I screw up, you're going to make a lot of money here. Does that make sense? Okay. And I already did all the due diligence. And I was in real estate already. But I had the home inspection, had a bid for the contracting work, and had an appraisal too. A lot of hard money loans, you don't need an appraisal. They call up a real estate agent and they ask, hey, what do you think of this? Okay, cool. I just, I ran a deal through my lenders, and it took them about like 15 seconds to get back to me on one of them. They're like, oh, I guess underwriting's done, because the loan to value was like 20%. We had a paid off property, and we need about 100 grand to work on something. The property's worth, 500 or something. We don't need much. It was just a no-brainer. So you can't get that conventionally. You can't, sorry, Mark, but you can't go to Mark and be like, hey, can I get a loan on this deal? And they call you back, less than 4 minutes later and be like, yep, yeah, when do you want to close? But Mark will get you much better financing, much lower rate, less points.
Well, I like what you said there too, as far as asking your hard money lender. It's like I would probably even go one step further and say, why should I not do this deal? Because I've talked to a few people off the ledge as far as why they shouldn't do the deal. You find something and you get on a contract and you get so excited about it, and online it's like, well, shoot, it's a little more work than what it needs, which you're capable of doing.
Yeah. And
you're paying too much for it, and I would not put my money at risk on something like that. So this is why.
Yeah.
And I think you'll find too that a lot of people that are hard money lenders or private lenders, they will say why they're not going to do the deal.
Yeah. Lenders don't like saying no. They want to lend money. They don't like wasting their time. They love to say yes. If they say no, it's because there's something wrong with your deal. Or you. If that makes sense. Or both. But it should give you some comfort if you need to back out of something if nobody's giving you a loan on it. Sorry, go ahead. There's another question.
So you guys have a cap on how much you'll lend on one deal?
They say 20 million. Okay. But it's got to be a really good deal. It's a lot of money to deploy at once. It's out of most people's comfort zone. But they want to do over $250 million this year. So they're willing to get a little aggressive if it makes sense. Yeah.
Do interest rates with the hard money loans typically rise with conventional? Or is it like, so, you know, at the height, conventional loans were up to 18%, but you can be 10% on a hard money loan. Does that typically stay about the same?
In my experience so far, it's not so much in line with what the Fed says, it's in line with what the competitors are at, and the supply of hard money that's out there, if that makes sense, and what the bottom line investors are comfortable with. But you probably won't see less than 8%. You probably won't see more than 12. Depends on the deal. There's a lot of factors that goes into it. Does that make sense? But it's more based off the market, or it's more based off the competition and what's worth it to an investor to do the work of, because it's a lot of work to generate a loan. If that makes sense. I forgot where I was going with that. But no, the rates aren't going to mirror what's going on with the Fed. Go ahead.
Let me just add that for Sarah, is that you'll never see interest rates on a conventional loan get to 14% as an example, and hard money loans are still at 8 to 12. They will always be, hard money loans will always rise, because if that's the case, then banks would be out of business because everybody's doing hard money loans. So you're going to typically see at least, on average, anywhere from 3% or higher, 3 to 5%, 3 to 6% difference between a conventional loan and a hard money loan, given the similar type of scenario, the 5 C's.
Yeah, the 5 C's. Go ahead.
So hard money lenders look any differently at VRBO? If somebody wants to buy something, fix it up, and then throw it out on a VR, it's not a monthly loan, rental, or not something they're going to flip, the VRBO.
Just a refi.
No, they're just they're more concerned with the value, and not as concerned with like verifying what kind of income they'll be receiving, like a debt service type of loan. So I mean, I've told, in my experience, I'm going to keep this as a rental. I'm going to keep this as an Airbnb. Lenders, they don't care. In my experience, does that vary with Kelly, with your hard money lender people? I don't think they care either way. Like they just, as long as you're, I mean, because at any time you can change your strategy, as long as you're meeting what the terms of the note are, pay it off within a year. Or, you know, this is what your payments are, make the payments. You can do whatever you want with it. Go ahead.
I think the key thing there, just to remind me, you actually said it, is the exit strategy. A hard money loan is going to want a year to loan, and then you got to figure out some other way to pay that loan off.
Yep.
So that's the key thing, is having an exit strategy. You're not going to keep a hard money loan for 3, 4, 5 years. You're going to want to put that thing off.
No, you don't want to. But I've done it, you know, with the very first rental I bought, I got a hard money loan for like 36 grand. The payment was like $300, and it actually worked as a hard money, because it was renting for $850, and I was making a couple $100 a month on a hard money loan. And I let it ride for a while until I eventually qualified for a regular loan to do a BRRRR on, and it took almost 2 years. But typically, so like with our loans, the standards, when we write you a loan, it's going to be on average, it's going to be a 12-month loan. That's just what they default to. And then if it takes longer than 12 months, it'll automatically extend by 6 months for a 1-point fee. And 1 point is 1% of the loan amount. So if you have a $100,000 loan and it goes past 1 year, there's a $1,000 fee that's going to be thrown into the mix when you go to pay it off. Does that make sense?
Okay.
Yeah. Any other questions? Yeah.
When you're talking about the ARV, do you factor in appreciation? Like you could say,
No.
You know what I mean? Like you'd say this house would sell for $500 now, but the market's going up 10% every 6 months, and it'll take you 6 months to fix it. So you have the ARV at 550, or
No.
you don't get that.
Yeah, appreciation is always, it's nice when it happens, but it's never expected or calculated in our in what we do. Yeah. I mean, what we should really look at is what, you know, will it go down? And make sure that there's enough margin to handle that.
Question behind the question is, how do you calculate an accurate ARV? Like, you're an agent, you're in the business, you see houses sell every day, but
Yeah, to calculate an accurate ARV. So you take the current house that you're looking at, and you look at 3 to 5 very similar homes. And you ideally try to get the last 90 days of those sold homes to come up with a value on the subject property of similar utility. And that's how you come up with an ARV. And ideally, homes that will look like what your home will look like when you're done with it. Ideally, same neighborhood or similar neighborhood. So like, there's a dump in Crown Point, but it's 1,200 square feet. You can compare it with other nice 1,200 square foot homes and come up with an ARV there that sold in the last 3 months or so. Yeah, but an ARV is usually calculated by past activity, not future activity or expected future activity. Yeah. Any questions? Any others? Yeah.
Can I add one more thing? And this is really critical. I still talk to people that think we're going to have a housing crash like we did back in 2008. Maybe some of you guys have as well. And the answer on why we're not is what you said there in the LTV portion, the maximum loan to value. Because we were doing loans back in 2006 of 125% of the purchase price. So imagine you wanted to buy a house that's $400,000 and the bank's going to loan you $500,000. So when you close, you got no money in the game, and you were given a check for $100,000 to walk away with.
And they didn't even check your taxes or anything like that.
Check your taxes, no income, they didn't have to check any of that. So how many of us would do that today if we could? Buy a home for $400,000, no down, and get $100,000 in your pocket. Every one of us. And we would do it as often as we could, right?
Yeah.
That's exactly what happened in 2006, 2007. And so that's what caused the run-up in home prices. The run-up in home prices that we've had over these last couple of years are for totally different reasons. They weren't tied to the loose credit. So as a result, my point there is anytime somebody says, I'm going to hold out, housing prices are going to crash, it's just like it was back in 2008.
It's not.
That's not going to happen.
And supply.
Yeah.
Supply was pretty balanced back then.
Yeah.
Supply was not what it is today. Housing is in demand. There is a serious demand and an affordability crisis at the same time. So it's very unique, and I don't think anybody can have a real accurate idea of what's going to happen over the next couple of years. My guess is that a lot of people are going to move away. They're going to move to Tennessee, wherever it's cheaper, wherever they can afford it. No, well, it's the people that you don't want to move away that are going to move away. If I could put any predictions out there, I think we're going to see a mass exodus, or whatever you call it, a mass amount of people that are moving away that cannot afford to live here anymore. Because supply is very low, demand is still very strong, but affordability is just not a thing anymore. And it kind of was a few months ago, but just with interest rates jumping a couple of points in just a few months, I mean, maybe half the people back then qualified for a loan. Now, 1 in 10? I don't know. I'm just guessing, but I don't know many people that could even qualify for a loan in this kind of market with the interest rates at where they're at.
Well, they actually move away or just stop coming because people that are here, in some sense, locked in, right? Effectively, well, I mean, locked in on whatever current mortgage they have.
Yeah. I think there's going to be a lot of families squeezing in tight with each other, a lot of roommate situations. I think there's going to be ADU building quite a bit. I think you're going to see a lot of what you see in other expensive markets, and I think we're going to mirror what you're seeing in the other really expensive markets of how people can afford to live in a place when they don't have that kind of income, and they're going to get creative and try to figure out a way for their property to generate revenue with ADUs or roommates, house hacking, those kind of things, or they're just going to move away if they can't figure it out. Does that make sense? Yeah. But I think there's going to be a lot of people that are going to leave. That's just my guess. Yeah.
Do you require inspections on the properties? So you got the appraisal, which means you deal with inspections.
Usually, I mean, just a quick walkthrough.
Yeah.
but not like an actual home inspection. Yeah.
Just make sure that it's real property and it's not.
Yeah, just make sure it's actually there. You're not just seeing pictures of a house that used to be there. Yeah. Yep. Any other questions about anything real estate related while we're here before we break out?
Another question.
Yeah.
Did you get pre-approved before you find the property, or is it you go, you like when somebody has a property in hand, they're gonna get,
I got some great news for you. You're pre-approved.
okay,
Now you just need to find a property that qualifies.
okay.
I'm not kidding. You look great. You're pre-approved. Go find a property that works. You're going to get that loan.
Typically, just to add on to what Nick's saying, we vet the property more than we vet the person itself. So if you come to us with a good deal, that's going to incentivize us to be like, yes, this is a good deal. We will get you taken care of.
It's a hard money loan. We're doing a loan based off the asset, not you necessarily. You're factored in a little bit, but it's mostly about the property. Does that make sense? And that's why I talked about money and water and all that weird stuff, because I want you to get it in your head what hard money is and what's the difference between a hard asset and a liquid asset. And how, and if you can get that through your mind and just know this is how money works in general, I think it's going to do you well over time and investments in the future. Does that make sense? Okay. All right. Feel free to stick around for till 9 o'clock. You got about 45 minutes. Do you want to do a book giveaway here soon, or do you want to wait? And we might still have coffee and cookies in the back in case you're thirsty and hungry. Okay. We'll give you 20 minutes to enter for the book. Thank you.